The guys at Cooper Fitch have just put together their annual CEO report, looking at what business leaders expect to see in terms of growth and activity this year, and what they think they might be paid to deliver it. We are very pleased to be joined by the managing partner of Cooper Fitch, Jack Khabbaz. It's lovely to see you, Jack. Good morning.
Good morning. Thank you for having me.
Remind us who you speak to and how many people, so we've got an idea of the scope
Sure.
of this
We
report.
speak to just over 100 CEOs in the region, primarily split between the UAE and the Saudi markets, being two of the larger markets in the region.
And the one thing that really stood out for me for this report was the difference between the UAE and Saudi in a lot of areas. Let's start with growth projections. The majority of businesses in Saudi reckon they're going to see between 5 and 10% growth in 2026. In the UAE, that's 11 to 20% growth. Why are we more bullish than the guys down the road?
Spot on. I think if you look at the UAE economy last year, look at sectors such as manufacturing, tourism, infrastructure, real estate, they've all had growth of 6 to 7% over the GDP. Saudi is going through a phase of Vision 2030, 5 to 6 years away. There's re-strategizing, there's reallocation of budgets, there's budget optimization. So there's probably perhaps more cautious optimism in Saudi versus the buoyancy amongst the CEOs in the UAE market.
Yeah, it is buoyant. I mean, 11 to 20% growth far outpaces GDP growth for this year, which I think most people are estimating somewhere around the 5.5 to 6 mark. What's that on the back of?
Success last year, I think sustainability. Dubai is the UAE is an international market. We have a very mature market in terms of industries and professions in the market here. So there's stability along with growth, along with new markets, new products, new services, backing of sovereign wealth investment funds and other funds as well in terms of driving sustainable growth. Not just short-term turnaround, but looking ahead. And the talent pool and the maturity of organisations where they are allows them to have that sustainable success and that optimism. Because that's been built. That's not off 1 year. That's been built over the past decade to be in that position to think, well, 43% of CEOs expect 10 to 20% growth the year ahead.
Does growth equal profitability, though?
It's another question. Not necessarily immediately. And we can see that with some of the bonuses released in the market, both here and abroad, and the tie into long-term incentive plans, and the costs and investment involved, particularly the first 2, 3, 4 years in many organisations before they really see the effects and the impact of what they've been building and developing.
I'm going to get to those bonuses in just a moment, but let's stick with the CEO projections for a little while longer, because there is, again, the split between Saudi and the UAE. Saudi CEOs expect to see a lot more M&A, merger and acquisition activity this year than the UAE, 23% compared to 4%. Is that just the consolidation around mega projects, or is there more to it than that?
That's definitely a starting point. Consolidation is a key word. We're seeing that across sectors in the kingdom. Various projects, whether they're mega projects or other organisations, other entities, there is a lot of consolidation. There's a lot of joining forces, JVs, mergers and acquisitions behind the scenes and front and centre for other organisations, as well as large holding groups looking to divest from certain portfolio companies that they may have and really pursuing return on investment in other areas of their business lines.
Which brings me to our other big split between Saudi and the UAE. What you call in this report the AI paradox. There's a lot more AI adoption in UAE organisations than there is in Saudi, or at least that's what the CEOs are telling you. UAE CEOs think that digital transformation and therefore AI is more of a driver than those in the kingdom. So we're doing more of it, but Saudi companies seem quite a bit more satisfied with its impact. So what the AI is actually doing for them. What does that tell us? What do we take from that?
Very good point. The UAE has an objective where AI will contribute 20% to the non-oil GDP. I believe we have a long-term sustainable plan when it comes to AI. Saudi, a lot of the AI initiatives are focused projects, short-term projects, whereas in the UAE, only 12% of CEOs believe that there's been significant impact from the AI initiatives. We are early adopters in the UAE. However, the results we'll see escalate over the next 3 to 5 years in terms of the adoption and the implementation and the actual return on investment. So there's a disparity, whereas Saudi have been implementing it in terms of short-term projects, immediate projects, and the UAE with a sustainable long-term perspective.
For private sector companies and the pressure that is on firms at the moment to show that AI is going to pay off, shareholders not happy to wait around on this. Does that long-term view work? Do they not need to show results a lot quicker than that?
They do. And results come in a number of ways and a number of strategies. Digital transformation, AI, product expansion and service and market penetration, they are still high priorities and high strategies for CEOs. They still rank very highly. So the traditional methods of customer service, innovating, selling, marketing are still absolutely critical, which is still going to achieve a lot of the results in that period while AI is being deployed and being executed over the coming years.
Let's have a look at the wages and bonuses that you mentioned there. If I'm reading your graphs correctly, slightly less CEOs expect or have already got a bonus for 2025. And out of those who've got them come in, more than half of them either got the same bonus, so no uplift, or even less. Are we seeing less rewards for CEOs, or are they not hitting their targets?
I think it's a blend. In the UAE, the sweet spot for annual bonus last year would have been about 3 to 4 months, majority of CEOs in that range. Versus Saudi, well over 50% were receiving bonuses, annual bonuses of 6 to 12 months. And that's not necessarily always tied to performance, believe it or not. Part of that is a retention tool, people sticking and really executing a strategy for the next 3 to 5 years. Also, there is work to be done in terms of bonus pools, long-term incentive plans, which are a core part of incentivizing leaders. Only half CEOs in the region have a long-term incentive plan. That's really important to have leaders who can drive long-term goals over the next 3 to 5 years.
20 seconds left with you. The vast majority of C-suite executives, according to this, are external hires.
Yep.
Is there the incentive to stay if you can see a glass ceiling, if you know you're not going to get one of the top jobs?
It's a good point. That's part of it. I think there's also the succession planning. Only 40% of organisations have a strong, robust succession plan in place for the next CEO. Also, the UAE market is highly mature, highly developed and very attractive for profiles and candidates from all over the world.
Right, so people are managing to find better people outside?
They are, but they necessarily shouldn't have to either if they have more robust succession plans in place.
Jack Khabbaz, Managing Partner of Cooper Fitch with the CEO Survey. Thank you for your time.
Thanks for having me.